2023 is shaping up to be one of the most volatile and severe recessions yet on record. That is according to our next guest, Heath, CEO of Metalla Royalty. How exactly should you, the investor, be positioned to navigate these risks and survive this coming storm? Well, let's talk about it. Brett, welcome back to the show.
Thanks, David. Thanks for having me.
It's important to note for our audience, Brett, that you and I are speaking right now at 1 p.m. Eastern time, so the Fed hasn't given its announcement yet on what they're going to do with rate hikes, but it's widely expected that they would raise by 50 basis points. The CME Fed Watch tool is pricing in an 80% chance of a 50 basis point hike today. But regardless of how much they raise, give us your outlook for 2023. You've got some grim news for us. Just give us the news straight.
Thanks, David. Well, I think that we're heading into a year of extreme volatility, and probably even the first half of 23 will be the most extreme as we get into next year. And this is because of a few different things. But let me walk you through the thought process here and kind of the thesis of why I think this will be the case.
Yeah, don't sugarcoat it for us, Brett. Give us your outlook for the economy.
Yeah. So look, at its core, the Fed's got two jobs. They have a job to keep inflation low, and then they have a job to keep America employed. And when you look at what's been happening primarily over the second half of this year, there's layoffs everywhere. Every time you turn on your computer, open up your phone, it's this company's laying off. We've seen layoffs from DoorDash, 7-Eleven, Ford, Tesla, Amazon, Twitter, Meta, Peloton, Lyft, just to name a few. The list can go on. So it's pretty clear that layoffs as a leading indicator for a recession, what I think will be a very, very severe recession here for the American consumer, is upon us. And we may even be in it today. Now, other leading indicators for recession is usually shipping rates. And if you look at shipping rates are down over 70% in the last year. Now, they were a little bit elevated, obviously, because of kind of the COVID-related supply chain issues, but 70% in the last year, and it doesn't look like it's stopping anytime soon. And you pair this with the consumer, the shape of the consumer today, I think is on the brink of basically, dire straits here. You've got savings rates that have gone from 33.8% in April 2020 down to 2.3% in October 2022. It'll probably be close to zero by the end of this year. And that's combined with credit card balances that have gone up 15% just in the last quarter in 2022, which year over year is the biggest increase we've seen in 20 years. It's actually an all-time high. I think credit card balances for consumers is upwards of almost $1 trillion now.
It is, yes.
So it's not looking good. It's not looking good for the average Joe in America. And I think that is going to lead into a very, very severe recession that I think we're probably already in. And the Fed is going to have to battle this inflation that's also not going away.
So a confluence of factors you're looking at that may point to a severe recession. We're going to talk about how severe in just a minute, but I want to talk about the credit card debt aspect. So just taking a look at this chart, we can see that from a percent change perspective, we had negative growth in credit card debt all throughout 2020 and 2021 because of COVID. As things opened up, that spiked up dramatically. And now, like you said, we're in double-digit growth territory. The latest number as of November 30th was 17.3% year-on-year growth in credit card spending. So that is, you're right, the most in a lot of years, going back all the way to 2010. So over the last 12 years or so, Americans have never spent this much in credit card debt. That could be perceived as a positive for the economy, could it not? One could argue people are spending money. Things are looking good. Perhaps people have money to pay off this debt with. I'm just speculating. I don't have the answer.
Yeah. Well, I mean, look, what my speculation is that people are using the credit cards to be able to pay for the inflation with all the prices that are going up, right? Like their food costs have gone up, their energy costs have gone up, their rent has gone up, school tuition has gone up, everything has gone up, and it's gone up a lot more than CPI across the board. If you did this, on your own, you picked up a basket of everything that you spend on, look at your credit card statements, it's gone up a lot more than what CPI is. And so how are people paying for this, right? Like you're seeing the savings rate go straight down, and you're seeing credit card rates go up. So it's pretty clear that Americans are hoping, they're hoping that inflation gets under control. They're hoping that things work out, but it just does not look like it to me. It looks like things are going to get really ugly here over the next 2 years. And I mean, one thing to point out that I think could be kind of a trigger of this is for most Americans and really kind of most people globally, I believe, in at least in the Western countries, their largest form of savings is their home, right? Like they don't really
That's
keep
true.
a lot of money in the bank. Their home, the money that they pay on their mortgage, every month is their form of savings. And when you look at housing sales, okay, so housing sales is a precursor to basically home prices going down. And when you look at housing sales, they've declined for 9 months in a row. In fact, I believe it's just around 30% decline in home sales over the last year. And that's also the longest declining streak on record since 1999. So, I mean, even the housing crash didn't have home sales. Now, what's happening here? Well, what's happening is that everyone refinanced their home or they went out and bought a home at 2% mortgage rate. They don't want to sell it. They can't sell it, right? Because if they were to sell it, then their rents are a lot higher, or they'd be forced to kind of rebuy something at a mortgage rate of 6, 7, 8%. But what happens when they have to sell it, right? What happens when that savings rate goes to zero and the credit card rates are so high and the credit card debt is so high that they're forced to sell that only asset that they have savings in? And that, I think, can cause significant contagion throughout the economy. And we're already seeing the smart money acting in anticipation of this. Look at Blackstone's $69 billion real estate fund, limiting with redemptions. Look at BlackRock's real estate fund. So the smart money is already kind of seeing this movement. Like what happens when people have to sell into a bidless market? It's not good. It's not good for real estate. And Blackstone's got $69 billion of it.
For sure.
People are trying to get their money out. So that is just going to put more pressure on what I think will be that severe recession that we head into. And the Fed's going to have to make a decision, right? Because inflation, okay, it's come down maybe 100 basis points or so. I can't remember exactly what the high was compared to where it was as of yesterday, but it's come off a little bit. We'll probably see it come off a little bit more, but it's not going to come off that much. And if the Fed has to shift because we get into a very significant recession, then how high can it go, right? I mean, maybe we see inflation CPI up in double digits. It's definitely possible.
I do want to point out that currently, you're right, the personal savings rate has been going down tremendously. It's at the lowest level since 2008 in absolute dollar terms. And as a percentage of disposable income, it is actually, get ready for this, it is at 2.3%. And in 2008, right before the 2008 recession, it was at 3.2%. So Americans have less savings as a percentage of disposable income now than they did in the last Great Recession. So you're absolutely right. Things are looking pretty bad. I wonder if now is a good time to buy bank stocks, considering everyone's loading up on credit card debt. That might be a financial sector to look into, but we'll talk about investment implications in just a minute. I do want to point out this stat to you, Brett. Advanced retail sales. So despite the fact that people have less savings, despite the fact that people are getting laid off, retail sales continue to make new all-time highs. In fact, I was reading on Black Friday, Shopify announced record sales, not just absolute terms, dollar terms, but also volume. What's going on, Brett? People are just pretty optimistic still. They're loading up on the credit card for sure. They don't have savings to spend on these things, but retail sales are still going up.
Well, I mean, I think that stat's a little bit of a mirage because a lot of that growth is really inflation based, right? Everything again is higher prices, and when you adjust the retail sales for inflation, you'll probably find that it's flat or maybe has decreased over that time. But the inflation really has a very dramatic impact into a lot of these numbers, and you got to be aware of that.
Okay, yeah, that's actually true. So from a percentage change basis, advanced retail sales were up 7.5%, and inflation, if you count for inflation, that's roughly a 0% net change. Now, let's talk about inflation. 7.1% was the latest reading that came in yesterday. Headline inflation came in at 7.1%. That's lower than 7.7%, which was last month's reading, and lower than actually consensus expectations for this month. So it seems to me that inflation is coming down at a faster rate than expected. Do you expect this trend to continue, Brett?
Well, again, it's going to come down to kind of what the Fed does and where their priorities are as we get into this significant recession. Now, remember, the Fed has raised rates at a faster pace than they almost ever had since, like the 80s. So, or the late 70s when inflation was very significant back then. So we haven't seen this type of a significant continuous raise in such a short period of time. It has had a little bit of an effect, obviously. We've seen inflation come down, but not that much, which is the crazy thing. You would think that if with all of these interest rate hikes, but more importantly, the asset deflation. I mean, the asset deflation across the board also has a pretty significant impact in the calculation of inflation. And so only to see it come down modestly kind of tells you that, look, it doesn't look like it's going anywhere. And in the event, the Fed does believe that the recession or keeping maximum employment is more important than the inflation, I think we'll see inflation kick up in much higher rates than we're seeing in 2022.
Brett, for those of us watching the show right now, they just want a realistic picture of how exactly severe this recession, this coming recession that we're talking about, is going to be, and what exactly this means for the average Joe across America and perhaps around the world. Now, you'll recall what life was like in 2008. If you're working in many sectors, including tech and the financial sector, life was not good for you. If you owned a home, life was not great. Many people got laid off. Wages didn't recover for many years. The stock markets didn't recover for many years. What's going to happen this time? Just for the average Joe who may not even be an investor, how is his life, his or her life, going to be different next year than, let's say, this year or 2 years ago?
Well, I think it depends on how you position yourself is the key. And you know, the market sometimes gives you sneak previews on how asset classes are going to perform. When you look at 22, these numbers are maybe about a week old, so they're not spot on, but approximately you've got Bitcoin down over 60%. You've got FANG stocks down 33%. Semiconductor down 29. Mega cap growth down 27. Nasdaq down 26. 30-year bond down just under 20. S&P 500 down about 15%. 10-year down 12%. Gold's about flat. So when you look in times of extreme volatility, you look in times of really kind of where a lot of confidence is lost within either the government or the financial system and so forth, you tend to see gold do really well. And gold hasn't gone up any crazy amount. Like I said, it's about flat this year, but I think that is going to be one of the places of refuge for 2023. And again, it depends on how people are positioned coming into the year and if they're paying attention to all of these numbers and everything that's going on.
How bad do you think unemployment is going to get? We're currently around 3%. Now, during COVID, that spiked up to double digits very briefly. Well, it made sense. Everyone was forced to stay at home. We don't have lockdowns anymore. Hopefully, those won't come back. But people are talking about higher unemployment regardless of lockdowns. What's your take?
We're going to see employment rise. I think we're going to see it rise dramatically. It probably won't go to the heights that it was during the COVID lockdowns, because that was kind of a very unique situation. But it's going to get to a level of pain where I believe that the Fed is going to have to seriously consider which one's more important in keeping inflation low or starving off one of the major recessions that I think we'll see over the last 2 decades.
So let's talk about gold now. One of the most commonly asked questions that I've been getting from gold investors this year was, why hasn't gold gone up even more? So as you said, relative to stocks, it's done quite well. Relative to the S&P 500, it's outperformed the S&P 500. It's outperformed Bitcoin, of course, by a tremendous margin. But still, when you look at all the confluence of factors working in gold's favor this year, we had a war in Europe, we had record high inflation, we had a slowing economy, recession fears. Why didn't gold spike up to, its all-time high? It did briefly in March, but then it came back down.
Yeah, I mean, gold's a tricky thing to forecast, but what we've seen again is we've seen incredible amounts of asset deflation this year, and that's across again all asset classes, whether it's real estate, stock, bonds, crypto, whatever asset class you want to pick. Pull up a year-to-date chart; it's likely down. The only asset class that was up this year is energy or energy-related activities, and that was kind of a unique situation because it was highly kind of correlated with the situation that we have over in Europe with the war. But asset deflation was significant, and you get these periods of asset deflation. I mean, if you look at, every crisis is different, but look at 2008. 2008, gold did come down when everything was sold, and it ended the year about flat. And in 2009, or I'm sorry, I believe it was, 2008 or 2009 when we had the big crash, it was about flat. Now, the following 2 or 3 years, you saw it go from $1,000 up to $2,000. So sometimes gold takes a little while to move. I think that's kind of where we're at. Obviously, this is a much different scenario than it was back in '08. But when you look at the kind of way that it's reacting, and you look at kind of the price action, it tells me that, looks like gold's going to move. And one leading indicator that I always like to watch when kind of looking at what way the precious metals want to move is the gold to silver ratio. And when the gold and silver ratio is moving in favor of silver outperforming gold, and the ratio going lower, then typically that means that both metals are going to make a big move. And if you look kind of what's happened over the last few weeks, we've had this kind of quietly reverse in direction from the gold silver ratio. And that for me, being in the gold business has been a pretty spot on indicator in regards to when you're about to see a big move in precious metals.
I know you're not in the business of giving forecasts. You're a mining royalty manager, and we'll talk about the royalty business in just a bit. But just give us an outlook for gold. What's a number that looks reasonable for you?
I mean, I think 2,000 is very, very reasonable right now. And I think once we kind of break to 2,000, we're probably headed up to 2,250 to 2,500, and that probably could be, I hate giving time, prices, and dates, but I wouldn't be surprised to see kind of in that range by the end of 2023.
Well, you did say that the first half of 2023 would be probably some of the most volatile months for the markets. Is that a good environment for gold, or perhaps bad? We have seen periods in the past when stocks and risk assets fell in tandem with gold, right?
Well, it could look in any type of extreme volatility and everything gets sold off. Gold can get thrown into that. We've seen that on a number of different occasions throughout the last 2 or 3 decades. But what you see is you see gold hold up pretty well. You see it get knocked down a little bit, but it holds up pretty well. It reverses. You start to see capital flows move in that direction, and when it does, that's when you see these long kind of 1, 2, 3, even 4-year moves. We saw that in the early 2000s. We obviously saw it after the financial crisis of 2008, 2009. And depending what the Fed does, obviously that's kind of the key. Everyone hangs on the Fed's words and what their actions are. And if they reverse and they stop raising rates or they reduce rates, then I think gold's got a much, much higher ceiling than it otherwise would if they continue to raise it.
All right, Brett, I want to close off and talk about the royalty business now. You are CEO of Metalla Royalty. Now, MTA is a ticker of your company. It's gone down about 13% year to date, which has outperformed many of the FANG stocks and outperformed a lot of the smaller markets as well. Tell us about the business model of royalty from an investment standpoint and what makes that kind of business model attractive for investors.
Yeah, so royalties are just an absolute fascinating business because what we do is we buy these non-dilutive interest on these mines. So these mines that are being operated by, for Metalla, some of the largest, most widely recognized big, safe mining companies around the world, we buy these interests, these 1, 2, 3% on these mines called royalties. And what these royalties are is they're a non-dilutive, free carried interest into perpetuity, meaning that we don't have to put out any further capital once we buy them. And once the assets go into production, we get top line, basically the gold ounces, the percentage of whatever's produced right off the top. So what's significant, or what I think is really compelling as an asset class, even though this is a kind of a tiny little part of the whole gold sector, is that these assets, they're not exposed to the inflationary pressures that the mining companies do. So if you're running a mining company, you've got infrastructure costs, you've got energy costs, you've got labor costs. And what we've seen over the last year with inflation creeping in, we've really seen margins get crushed with a lot of the mining businesses, with a lot of these assets, because gold, again, didn't make that move with inflation. It kind of held its ground. I think it will make that move and the margins will expand. But over the last year, those margins have been cut. And in the royalty business, you get basically almost 100% margin. So you can be in an asset class that is, obviously, I think one of the refuge types of asset classes in volatility. At the same time, you can be in a space where you can see these things grow, you get leverage as the companies make new discoveries. Obviously, the royalty applies to the broader package. So it's just a really incredible type of financial asset when you look at getting exposure to real assets that have correlation or leverage to gold or silver.
Okay. And give us some news out of the company. You've made a series of acquisitions from both First Majestic and now the latest Barrick. Tell us about that.
Yeah, so we've made two acquisitions in the last 30 days. We acquired a portfolio of royalties from First Majestic Silver. First Majestic Silver is one of the leading global largest silver producers in the world. And we worked with them to monetize a portfolio of 8 non-core assets, which will give us near-term cash flow, near-term development, but most importantly, a huge amount of leverage on silver, which we're really excited about. And we also recently announced earlier this week an acquisition on a royalty over the Llama project. Now, the Llama project is part of one of the world's largest gold deposits, and it's currently being contemplated as a standalone operation with Barrick Gold, who's also one of the world's largest gold mining companies. And they've committed about $75 million over the last 2 years to do drilling, to evaluate, and do a number of studies to see if that is a viable project to be a standalone operation. But where this is elephant country. It's where company making royalties are, and so we wanted to pick that up to really position our shareholders in front of all of that news that's going to come out on this project over the next 2 years.
Perfect. Well, Brett, good luck with your venture, and good luck with the new acquisitions. And thank you for spending time with us today.
Thanks, David. Thanks for having me.
And thank you for watching Kitco News. I'm David Lin. Stay tuned for more, and don't forget to subscribe to our YouTube channel.